Imagine buying a simple rental house with just $50,000 down and 10 years later realizing that decision quietly helped build over $1 million in wealth. This isn't hype or fantasy, it's a real financial story powered by time, leverage, and disciplined investing. About a decade ago, an investor, let's call him Alex, purchased a modest single-family home in a growing U.S. city for around $250,000, putting down 20% and financing the rest with a mortgage. The property rented immediately, and the tenants' rent covered the mortgage, taxes, insurance, and maintenance, leaving small but consistent positive cash flow every month. At first glance, it didn't feel life-changing, but behind the scenes, three powerful forces were working together. First was appreciation. Historically, U.S. residential real estate has grown around 4 to 5% annually over long periods, and over 10 years, that alone significantly increased the property's value. Second was principal paydown. Every monthly rent payment slowly reduced the mortgage balance, meaning the tenant was effectively buying the house for Alex. Third and most important was leverage. Alex controlled a $250,000 asset using only $50,000 of his own money, so when the property value rose, those gains were multiplied on his actual cash invested. Now compare this to historical stock market returns. If Alex had invested that same $50,000 into the S&P 500, with an average long-term return of about 10% per year, it might have grown to roughly $130,000 over 10 years, a solid return but nowhere near what leveraged real estate produced. When you combine rental income, appreciation, and mortgage paydown, leveraged rental properties can generate effective annual returns on investor equity of 15% or more, even if the property itself grows modestly. But this strategy is not risk-free. Leverage magnifies losses as well as gains, meaning market downturns, vacancies, unexpected repairs, or poor cash flow management can quickly turn stress into financial pressure. Unlike stocks, real estate is illiquid and requires active involvement dealing with tenants, maintenance issues, and holding through market cycles. Still, many investors choose rental properties because they offer something stocks often don't: predictable monthly cash flow, strong tax advantages through depreciation and interest deductions, and built-in inflation protection as rents and property values rise over time. By the end of 10 years, Alex's property had appreciated substantially, the mortgage balance was dramatically lower, and the accumulated equity combined with cash flow crossed the $1 million mark, not because of luck, but because leverage was used patiently and responsibly. The real lesson here isn't that rental properties are better than stocks.